So the question is regarding the new addition to the portfolio on Amazon. What are your thoughts and the valuation on Amazon? And by the way, Earl just asked in the chat, so just so you're aware what he asked, it says the fund increased its position in Amazon and had a disappointing first quarter in 2022. If inflation remains high for an extended period of time, Amazon's profitability and growth trajectory may turn out to be lower than consensus for several years. The share is currently traded around 40 times 2023 EPS estimates. EPS is earnings per share estimates, which may leave room for further multiple compression. How do you view the risk reward proposition going forward? So similar type of question. Take it away. What are your thoughts on Amazon?
Who do you want to have do this one?
What?
Do you want me to go or do you want to go? I'll leave it to you.
Yeah. So yeah, maybe I'll start and then I'll turn it over to you so we can kind of both be talking and not just like one person droning on.
Yeah, sure.
So I would just say that the way that we first, so we have a big position in Microsoft and have had a big position in Microsoft for a long time. And you know, what initially led us to be so interested in Microsoft was their software, their business suite of products like Office, Excel, those sorts of things. And we found them to be, you know, it's exactly what we want. It's sort of a protocol network. Because I use Excel, other people use Excel. You know, because I use Excel, because everyone else uses Excel, I have to use Excel. And so it leads to this, and it's a very small part of your budget. And so it's sort of like, if they raise prices by 10%, you're just going to pay it because you have to use it and it's a small cost. But over time, a bigger and bigger percentage of their business has become this infrastructure as a service business, which is essentially, if you think about it, sort of like the digital railroad all around the world for cloud computing. And it's really just an incredible business where you have, you know, this massive physical network of infrastructure that they've created, which is sort of like that railroad. Then you've got a protocol network effect, which is that all of the engineers working are trained on the language, and it takes a long time to learn it. And so they're all incentivized to kind of keep doing AWS or Microsoft's product Azure. And it's very hard for a third competitor to come in because everyone's already trained on these other two. And then they also have a marketplace network effect where they have sort of an app store ecosystem where engineers, you know, people are always building services and things that are useful in AWS. And the more people who use AWS, the more it's valuable to developers to develop for AWS. And so you have this classic app store marketplace network effect. And so that's kind of what, and just like we have in other of our businesses, a lot of these businesses tend to become sort of oligopolies. And so, like in the case of MasterCard, we own both MasterCard and Visa, you know, because they're essentially the oligopoly, the sort of digital railroad for payments. And then we also own, for instance, Aon and Marshmac, the two insurance brokers that are essentially, you know, a toll booth on global insurance volumes over time. And so I would say that, you know, owning Amazon is just consistent with that theme of that we wanted to own the two clear dominant winners in that very attractive category. But then we also love the e-commerce business, which I'll let Brian get into as well.
Sure. The e-commerce side is the side that probably everyone is more familiar with. So what's interesting about the e-commerce side, I want to first just mention how when you think of retail, usually retail is an area we tend to avoid. There's so much disruption that's happened. It used to be that everyone thought Sears is the dominant retail company, and then it became Walmart, and then Amazon up and came. And what's usually retail they struggle a little bit to have high returns on capital. They have to offload that capital because the brick and mortar's an inflationary, very big asset capital intensive asset. And then the labor also is inflationary. And what's genius about what Amazon did is they basically laid off the inflationary brick and mortar and the inflationary labor to technology, which is a deflationary expense. And so that would just start to say that's the genius of the e-commerce side. But then as they've continued to build out, I mean, they've literally now built a network that is larger than FedEx altogether. Like literally they're bigger than FedEx. Amazing to me and staggering to think that they've done that. And what they're following to some degree is a little bit like a Costco model and a little bit like an eBay model. So with Costco, many people on this call probably have a Costco membership. You may be surprised to find out that if you look at the financials of Costco, they sell everything at cost. So they just say, how much does it cost to buy these goods, to put them in a warehouse and own on this piece of land and get them to the consumers. And they sell everything right down to the cost for them to get you that good. So at the end of the day, how come they're not making zero profits is because literally their profits equals essentially their annual membership fee. And so what's neat about that is in retail, it's always been a race to the bottom, who can get the goods the cheapest to the people. But by doing this annual membership, they've created that pricing power through that each year they can imperceptibly raise prices on the annual membership by just a few percent to maintain pace with inflation. Whereas most businesses, if they're raising prices, they can't raise it as fast as inflation over time. And so it allows them to keep increasing the subscription costs. Then they found that as they were trying to get these goods to everybody, that it was much more profitable to have a third-party platform so that they don't have to take all that capital and plow it into getting all these goods. And so the third-party platform is a lot like eBay, where there's a network effect where we all go onto this platform and other people sell their goods through Amazon as well. And then they just have pricing power on the fee because it's very difficult to find another platform where there's so many users. And so it's a virtuous cycle where as each additional user gets there, it adds more value exponentially to everybody that's involved. And then because of that, they've also been able to add on a advertising component that's much like Google, where because a lot of us now will skip Google search altogether and we'll just go straight to Amazon and type it in the window, they're able to now sell very effective, high return on investment advertisements to businesses. And the reason I'm lumping all of this in on e-commerce is, and then the other piece, by the way, is the Prime subscription that also comes with, basically it's like a Netflix business. And I think of that as more like a loss leader. They're spending on content and they're adding value to the subscription membership. In fact, if you were to add up the value of an Amazon membership is far superior to if you were to add up the components of having a Netflix subscription plus a Costco subscription. And so there's untapped pricing power there, which means they could raise, I know for me, if they raised prices on Amazon Prime, I'd pay it. Like they could raise it 10%, 20%. It really doesn't matter, but they can certainly.
In fact, I would just point out that they just did raise prices and had, over 90% retention, I think it was like over 95% retention. So,
yeah. And there's about 150 million subscribers in the US, 50 million international. So that's 200 million subscribers. And so when the question was asked about valuation, one way you could look at it is just, you could say, okay, how do we try to value this based on, you could look at the number of subscribers, what they pull in, just like it's Costco, and then say, okay, this is maybe a way to get a valuation, and put a Costco-like or a Walmart-like valuation. Another way you can do it is you could look at gross merchandise volume. Actually, Will, I think we prepared some slides, as I recall. Do you mind putting those up?
Not at all.
So we can have them see. So this is Amazon Web Services. So this is AWS, which is that cloud infrastructure that we were talking about. And I think the thing that I want to point out is that the Amazon stock price is down 38% year to date. And I think that if you don't know what you own, that's very scary. But when you look at this is what brings me peace of mind and comfort. Is I look at this and I say, oh my goodness, look at the revenue and look at the operating income. They have this last quarter, 35% operating margins. That's how much money you make after all expenses, except for interest and taxes. But all the earnings divided by revenue is about 35%. That's extremely profitable. And that's because of the network effects that we were talking about, the protocol network effect, the physical network effect that's hard to duplicate, and then the high switching costs. If you put all your stuff in the cloud, not only is it high switching costs for the engineers, but it's also difficult to just switch it's like trying to switch an engine out of an airplane while in mid-flight. And so it allows them, initially, what I'll admit is that when we owned Microsoft, as Elliot pointed out, we owned it for all the digital software pieces. Azure ended up being this amazing thing that we didn't even see up and coming. And then as it grew and grew, we were worried, is this just going to be a commodity? Meaning that prices would come, everyone would compete, they'd see the value and drive the prices down, and that would not be very profitable. But what we've seen is Azure and AWS have proven, and we understand why now, with these network effects, why they're able to maintain pricing power. So despite the stock price dropping, what you see is earnings are just growing at a rapid pace. Go to the next piece. Oh, and by the way, this is the main thing I was going to say about valuation. This AWS piece, in my personal opinion, justifies Amazon's stock price alone. If all you did was say, I want to pay today to buy AWS, I think that that's a fair price to purchase AWS. And I believe that you'll get an attractive, likely double-digit rate of return by buying into Amazon, into AWS, just from at this price level, which means essentially I'm saying you're getting the entire e-commerce business along with its advertising function and the third-party platform, all wrapped in for free. Now, if you want to say, well, I'll get a much better deal, I mean, the fact is the other pieces are, that e-commerce side is probably worth 400 to 500, maybe 600 billion alone. And the market cap is 1 trillion. So another way to look at it is to say you're buying into AWS at an extremely cheap price. Take it to the next slide, if you would, Will. So this is the gross merchandise volume that I was referring to, that this is how much total is being sold on the platform. So there's the first party, which is Amazon retail. That's the goods running through Amazon. And you can see the growth there in the gray boxes. But you can see, as I was pointing out, that the third party piece is growing much faster. And it's estimated that last year there was 600 billion of gross merchandise volume that went through them. Now, just to give you an idea, take it, if you would, Will, to the next one. This to me is just staggering. In 2019, right before COVID comes into play, at the end of 2019, there was 192 million, if you see on the North America line, 192 million square feet of, this is fulfillment and data centers in just North America. 2 years later, Amazon has literally doubled the square footage of their fulfillment centers, completely doubled it. I mean, Amazon was massive 2 years ago, and they doubled their size in 2 years' time. The employee headcount from 800,000 to 1.6 million. It's amazing. And what they're doing is, I mean, I know I super appreciated having them as a service during COVID when we're cooped up at home and hiding in our homes. And so you're providing a real value. Like, we are owners of a business that's bringing great value to the world, both on the e-commerce side and the AWS side. Now, to compare these numbers to Walmart and Target, if you go back to 2015, you'll notice here, actually keep that slide up there, Will. Right. The North America, it says 71 million. If you back out the data centers, there was 67 million square feet in December of 2015 at Amazon. At that same time, Walmart had 120 million. So Amazon was half the size of Walmart, and Target had 52 million. Fast forward 5 more years to December of 2020, retail square footage for Amazon grew to 247 million. So about 4 times the increase. Walmart only went from 120 to 143. and Target only went from 52 to 54. But essentially at this time, Amazon, their e-commerce business is literally twice the size of all of Walmart's square footage. So if you add up Walmart's retail floor plus their distribution centers. So anyways, it just helps you see just what a powerful business and what a dominant business we own. And for all the reasons we've explained, we believe that's pricing power and a very long runway of growth to continue to invest at these high rates of return.
And I would just say the one other point, and another way to look at it is if you assume that, Amazon just passed Walmart in terms of gross merchandise volume relative to Walmart's revenues. And if you assume that Amazon earns, so right now Amazon's in a massive expansion, as Brian showed, and they probably overexpanded relative to the demand that they needed. And so profitability currently, and then they've also, again, it's this growing abundant cash flow company. So they've been spending a lot on a lot of Google has these sort of other bets that they're making, sort of moonshots, and Amazon has a lot as well, but they don't sort of break it out. But in any case, Amazon's business could be very profitable right now if they wanted to, but they're trying to grow and become even more dominant than they already are. But if you just put a Walmart margin on Amazon sales, and then also included the AWS business, you're essentially buying it for the same price as Walmart. Yet Amazon is, because of that AWS piece. So number one, the retail at maturity might actually be, if you think about Walmart's at 4.5 and eBay is at 30% margins. And so maybe Amazon's retail margins are actually 10%. So it's even cheaper. But even if not, AWS is growing so fast that Walmart's, you're paying the same multiple as Walmart, but the combined company Amazon is growing its margins and its earnings way faster than Walmart, and should for the next number of decades. And so we think it's just sort of a really great example of an opportunity that our long-term focus on sustainable returns enables us to participate in a time period where everybody's time frame has shortened dramatically because of fear related to the recession, potential inflation, et cetera.
So coming back to this concept, I think the main theme that we want to come out of this call is that despite the portfolio being down, a rough start to the year, with inflation, with Ukraine and Russia, what I hope that people are catching as we're sharing this is that here's a perfect example of a stock that's down 38%. And we're actually excited about that. It's not something that's scary to us. Just ask yourself the question, do you believe Amazon will be materially larger 10 years from now than they are today? And if the answer is yes, then I think that's very high likelihood that the stock price will follow. And when Elliot was mentioning how they're hiding their profits basically by reinvesting everything, they can use that search business or the video subscription business. They can use all these pieces to bring the cost down of goods. I've noticed, I don't know if you guys have noticed this too, but there are literally some goods that I can buy on Amazon and have delivered to my door same day for less than it is for me to get in my car and drive to the grocery store and pick it up, wait in line, go back to my car, drive it home. I mean, that's amazing to me. I can literally same day get it delivered to my house for the same price or less.
And it's because they've come up with this model that, like Brian said, it's part Costco, part eBay, part Google, and so part Netflix. And so they have all these different ways to monetize. Whereas like Walmart has one way to monetize, sell goods and try to make a little margin on them. Or, Netflix has one way to monetize, like sell streaming and try to get people to pay for it. Whereas Amazon has all these different ways to over time, like create economic profits for its owners, which makes it sort of you ask like, can you compete against Amazon on retail or on AWS? And it's sort of laughable that like a new competitor could come into either infrastructure as a service or e-commerce and really like compete with them on either side.
All the stocks we've mentioned should not be considered a recommendation to buy or sell the stock. Consult your financial advisor for your specific situation. You can also request from YCG a list of all the securities that we've recommended over the last 12 months. Thanks for watching. Check out our other videos and we'll see you next time.